Hello, this is Doug Gerlach, the president of iClub Central Incorporated and editor-in-chief of our two investing newsletters, the Investor Advisory Service and the Small Cap Informer. It's March 31st, 2020, and I'm here to discuss investing in turbulent times as part of this special Better Investing member webinar. Tonight there are 1,000 of you in our auditorium, so we are filled to capacity to look at the market during this difficult period and try to provide some perspective for you as individual investors. During this presentation, I'm going to be providing something of an overview of where the markets are right now and what's driving them, including the pandemic, the bear market, and the threat of a recession. We'll also be discussing some practical tips that individual investors can do, and I'll leave you with some investing ideas to consider for your personal portfolio or your investment club portfolio. I will note that this may well be a perfect storm with the confluence of the pandemic, the bear market, and the recession all coinciding. There's not much in the way of direct parallels in history to provide a lot of precedence and perspective for this current situation in the market. However, I still believe that looking back at history of the stock market in the US and globally, looking at the economy, the cycles of the American business throughout recession and contraction phases and expansion phases of the economy, and the history of bull and bear markets can provide us with some context and some insight that will guide our actions going forward. So let's start off and talk about what's going on in the markets today. As of the end of the third quarter, of course, the global pandemic is well underway, was initially declared a pandemic by the World Health Organization on March 11th, 2020. As you all know, the cases and deaths continue to rise. They've been reported in all 50 states. 30 states are now in shutdown in some fashion, and more are expected. And there are massive efforts underway to flatten the curve, to push out the response and the demand for healthcare so that we can treat as many people as possible. Of course, many businesses are closed by government mandate and others are closed voluntarily, and that obviously is going to create a lot of economic situation concerns for small business owners and large businesses alike. Those economic effects are going to hit the country pretty hard in the first 2 quarters of the year at a minimum, according to most estimates at this point. Now, the COVID-19 coronavirus outbreak, you've probably seen the headlines. This is a graph from March 30th that shows the total cases and the total deaths, both plotted on a logarithmic scale. So that uptrend on the right side in both is very disturbing. It means that the total number of cases and deaths is rapidly increasing, which just demands more of a response from governments and from individuals. In looking back at other pandemics of the 20th century, we can see some parallels to the current situation, starting with the Spanish flu, which hit in 1918 and 1919. An estimated 20 to 50 million people died worldwide. Those numbers are very broad because of the lack of data and record keeping from the period. In the US alone, an estimated 500,000 people passed away from the Spanish flu, and a mortality rate was estimated at 2.5%. About 1/3 of the world's population was eventually infected with this influenza virus. The H2N2 virus, also known as the Asian flu, arrived in 1957 and 1958, caused about 1.1 million deaths worldwide and 116,000 deaths in the US. The mortality rate there, 0.5%. The GDP in the US fell 8% in the first quarter of 1958 as a result of that pandemic and the effect of closings of schools and businesses across the country. The H3N2 virus, also known as the Hong Kong flu, arrived in 1968, also responsible for at least 1 million deaths worldwide and 100,000 deaths in the United States. Mortality rates similarly at about 0.5%. But in Hong Kong, approximately 15% of the population died as a result of that virus, 500,000 people, because of the isolation of the island and the close quarters of the citizens who live there. So today, the COVID-19 virus has arrived. So far, 40,000 people have passed away, and that number is increasing daily, 3,400 people in the United States, and the mortality rate is an astonishing 4.8%. But if you look at all the closed cases so far, the mortality rate is closer to 19%. So that takes into account the people who are no longer showing evidence of infection. In other words, they've survived, as well as the death rate. But we've got many more active cases, and so hopefully that mortality rate will drop below that 19% level once more cases are diagnosed and more people survive the infection. JP Morgan estimates that GDP will shrink at an annualized 14% in the first quarter of 2020, which would be a fairly significant drop in the GDP, leading us into the recession that we'll talk about in just a few minutes. I think it's interesting if we look at how markets responded to some of these world epidemics and global health crises that give us some idea of what we might expect going forward. We're seeing the initial stages of a market decline, but if we go back in time and look at the impact of the Spanish flu, the Asian flu, the Hong Kong flu, we see that the upward direction of the market in the short term can be affected, but over the long term, the market continues to push upwards to new highs. Other pandemics also plotted on this graph, and you can see that we really are it's not at all obvious when we look at this graph that any of these pandemics had a direct response, and certainly not a long-standing response or impact on the market over time. And so that is some cause for hope as we go forward. If we look globally at the Morgan Stanley World Index and look at a whole lot of different epidemics and pandemics that have plagued the world, including Ebola, Zika, measles, MERS, SARS, swine flu, dengue fever, HIV, pneumonic plague. We see the impact on this graph and table, the market returns 1, 3, and 6 months after these epidemics were recognized. And you'll notice that on the 6-month column, only a few of these pandemics had slight declines after 6 months. Plotted on the graph, again, you can see the upward bias of the market as a whole, and the fact that each of these epidemics, pandemics, health crises by themselves didn't seem to have a whole lot of impact on the market. Sometimes the market was going up and remained so. Other times the markets were going sideways and kept going a little bit. But it's pretty clear that the global markets aren't impacted over a very long period. In the short term, there can be some significant impacts, but as time goes by 6 months, most of the impact of those epidemics has been shaken out of global markets. Here's another graph from Ned Davis Research that shows various global health emergencies relative to the S&P 500 performance, both before for 12 months before and 12 months after the declaration of those emergencies. And so you can see, again, if the market was heading down prior to those emergencies, if the market was heading up prior to those emergencies, on average, the S&P 500 continued to move in an upward direction within a year afterwards. And so it's, again, the bias is there. And the global health crises don't generally take a whole lot out of the market for very long periods of time. So from that perspective, many of these epidemics, of course, are fairly regionalized, but the COVID-19 coronavirus is a more global affecting epidemic, so that is definitely going to have an impact on different markets around the world. But by and large, the markets are resilient. They do survive. They've survived major epic events besides health crises, including 9/11, the Gulf War, the financial crisis of 2007, various market crashes along the way. So we're pretty confident the market is going to survive COVID-19 as well. There will be adjustments along the way. There will be some tough times yet to come, I'm certain, for many in the country, but the long-term perspective remains just as healthy as it's ever been. And so we shouldn't lose hope for that reason. Now let's talk about how the market has been performing here in the first quarter of 2020, how it's responded to this crisis. Well, we set one big record for the week ending March 28th. The Dow Jones Industrial Average had its largest weekly gain since 1938, up 12.8% for the week. The S&P was up 11.8% that week. That's a phenomenal rate of return for 1 week in the market. But of course, that's overshadowed by the quarterly performance of the Dow and the S&P 500, with the first quarter being the worst quarter ever for the Dow Jones Industrial Average and the S&P 500 over the course of its history. On this graph, the S&P 500 is in blue on the top, down 20% as of the end of the quarter, with the Dow Jones Industrial Average down 23%. The S&P Small Cap 600 in green, down a whopping almost 33% year to date, as small caps bear the brunt of the market carnage so far in 2020. But no surprise, some more records here. 3 of the 15 biggest one-day decline of the Dow Jones Industrial Average happened in March of 2020. With the second largest drop ever on March 16th, a drop of 12.9%, a drop of 10% on March 12th, and a drop of 7.8% on March 9th. Put those all together, that it's a pretty serious decline in the market. Of course, the market has been moving up, moving down, with an increase of volatility. If you look at the VIX index, which is the measure of volatility over the last year, you can see just how much since the end of February the volatility in the market has increased. That's something we all probably reflexively know. As we look at the market, we see the gyrations, the big performances one day followed by big drops the next day. You never know from one day to the next which way the market is going to move, and those volatility levels are reaching pretty significant levels, coming back a little bit at the end of March, but still much higher when volatility was running well below 20. To have it reach up to 60 and as high as 80 is a great increase in the overall marketility. And no surprise, the short-term markets are pretty unpredictable right now. In fact, when we look at the volatility, the current levels are as high as they've been at any point in the last 30 years, including after the financial crisis of 2007. The market's being whipsawed to death as a response to headlines and political maneuvering. And it's important to keep in mind that it's not fundamentals that are driving this market, but emotions. There's a lot of fear, there's a lot of uncertainty, and when you put those in a pot and stir them together, the markets are going to react accordingly. And one thing to keep in mind, however, is that even if the uncertainty is increased in the short term, that does not impact the long-term direction of the market. So we want to keep focused on the longer term. And even after this 20% decline year to date in the S&P 500, the S&P 500 is up 132, almost 133% since 2010. So just over a decade in length, the market has had a pretty good 10-year track record as of incorporating the recent decline. Small cap stocks, again, hit hard by the market maneuvering in the first quarter and down quite a bit. And down below at the bottom is the EFA, the Europe, Australasia, Far East Index, which is down 4% from 2010 as global markets in developed countries have been struggling throughout much of the last decade. If we go back in time even further to 2000 to present, so we get a nice 20-year period here, the S&P 500 still in positive territory at a 76% gain, and that includes the nasty bear markets of 2000 and 2007, knocking it down. Those returns down quite a bit, but still showing in positive territory. And again, as we look at the indexes to get a sense of the overall market, our understanding as individual investors and stock pickers is that we can find the best performers within the indexes, within the market, and perhaps your returns will be a little bit better than the overall market. And when we talk about the market, of course, this is the bear market of 2020. Or is it? And as it turns out, if we look at the definition of what a bear market is, a bear market's defined as a 10%, or first of all, correction is defined as a 10% decline from the high. We've had several corrections in the S&P 500, the broader market, in the last few years, but they have not gone on to that 20% decline, which is the trigger of the start of a bear market. It's important to recognize that different sectors and market segments can have their own corrections in bear markets. The small cap stocks have had bear markets where they've hit for a couple of months, dropped 20% and then recovered, while the broader market was in a correction stage of between 10 and 20%, not actually triggering a bear market. In March, as the markets zoomed past that 20% mark on their fast decline, the official bear market of 2020, which is the 9th or 10th, depending on how you calculate them, since 1920. And then a bull market is defined as a 20% increase from the low. And what's ironic is that technically the bear market that started in March, when the market surpassed a 20% decline, also ended in March as the market bounced back more than 20% from the low that it reached. So technically we are in a bull market phase again. And that's the problem with the definition of a bull market. Usually bear markets are thought of as extended phases of down markets. So there are some who argue that, yes, this is still a bear market, even though we're up 20% from the lows that were reached at the lowest point of the market, and we're still down 20% from the start of the year. So I think for all intents and purposes, we are in a bear market phase, and we should be thinking about bear markets, because even if we do have some up days in the market, no one's really expecting at this point that the markets are going to completely recover and go back to making new highs again for quite some time down the road. And that's why it's useful to look at the history of bear markets. When you look back over time, the average bear market loss was really 35%. So they would hit that 20% mark and continue down before reaching a trench and then coming back up, or a trough and coming back up. The smallest bear market loss was 21% in the 1949 bear market. The largest in 1932 was a 62% decline in the market. And coming on the heels of the 1929 market crash, that was a pretty serious destroyer of wealth in the late 20s, early 30s. On average, bear markets occur every 3.4 years and last 10 months on average. And since 1966, bear markets have lasted on average 17 months or so. So we've had fewer bear markets, but they tend to last just a little bit longer. But the last bear market we've seen in the US prior to this was March 2009. So we had an 11-year bull market, the longest on record. So we were due for a reckoning, we were due for a pullback, we're due for a bear market any way you look at it. What's interesting when you look at the history of bull markets and bear markets is the duration and return, the size of the market. So this graph from the Schwab Center goes back to 1966. The blue boxes show you the duration and the return of the bull markets, while the red boxes at the bottom show you the duration and return of the bear markets. And it really points out that in recent years, the bear markets have been both higher in their total return, average return, and longer in duration than the bear markets. that's important to keep in mind as a long-term focused investor, that we invest because of the blue boxes on this graph. We don't worry so much about the little red boxes. It's easier said than done in many cases when you're looking at your brokerage statement or club's valuation statement on a regular basis, but the reality of the data indicates that we should be focused on bull markets, and we just want to get through the bear market phases. Here's another graph that shows the same data, but it illustrates it in a different way. So again, the blue areas are the bull markets, the orange red areas are the bear markets, going through 2018. So this would have continued into 2019, into 2020, when the current bull market would have ended, or the most recent bull market would have ended, and the bear market then initiated. And we're down from peak to trough in excess of 30% for the decline into the bear market of 2020. But again, we shouldn't focus too much on avoiding these bear markets. They are inevitable. We can't predict them. We can't move out of them in time to make a difference in our portfolio. And in fact, market pullbacks can be quite healthy. I don't think it's any surprise that when you look at stocks in the last few years, that the PE ratios of many companies have been much higher in the last 5 to 10 years than maybe they were in the past. And that's just an indication of a lot of money in the market, a lot of demand for stocks. There's a relatively limited supply of stocks, so the price of the stocks goes up. There's no alternative. You may have heard that abbreviated TINA, T-I-N-A. There is no alternative to equities. People don't want to put their money in the bank. They don't want to be holding bonds. There are other assets that are not as attractive as equities for overall total return. And so as all these people are putting their money into the market, it keeps the market valuations high. So a bear market can help wring out some of those excesses and bring down the prices to the ultra long-term average trends. I'm going to reset PE ratios in many cases to reflect something that's closer to the average that companies experience throughout the bull and bear cycles. So we've had an especially overvalued bull cycle, in my opinion, in the last bull market. So I think it's useful for us to remember that the long-term trend is more powerful than any bear market. And so if we think past this bear market into the next bull market and where that's going to go, and whether it's in a couple of months, whether it's in a year and a half from now, that helps to ground us in our investing approach, ground us in our portfolio selection and diversification plans, and give us the optimism that once we go into that next bull phase, which might be 5 or 10 more years down the road, we're going to have a lot of room for growth and opportunity for our portfolios to perform. If we look at the S&P from 1982 to the present, you can see clearly the drop-offs of the 2000 bear market, the 2007, 2008 bear market, and then since 2009, you can see drew some trend line here on this graph to kind of represent the excesses of valuation on the upside and the downside. So you can see things have been running closer to the top of that trend line for much of the last decade, which I think kind of represents this bias towards overvaluation as opposed to a more reasonable valuation. The antidote for this is to look back at how companies performed in the bear market phases, in the recessions that we've had in the past, but our stock selection guide tool doesn't have the capacity to go back in time, and so it's obscured it for most of us. But my belief is that we have been running at a very high valuation, so a shock to the system has an even more amplified effect, and that's what the COVID-19 pandemic has done to the market. It's caused it to contract more than it would have otherwise because of all these factors that push the market into such a high valuation range. So a lot of people want to know, so when's this bear market going to reach bottom? When's it going to end? There is absolutely no way to predict it. If anyone had been predicting, if any number of experts have been predicting the coming bear market, other than the perma-bears. The perma-bears are those who always are bearish in their outlook. There were no major calls to pull out of the stock market before the pending crash. It took so many people by surprise. Even professionals have been doing this for 30, 40 years. So bear markets, just like bull markets, they're impossible to predict with any degree of accuracy that makes any particular action possible, whether it's to buy or to sell, to move assets around. And any strategy that any investment advisor touts that depends on knowing when a market bottom or top is reached is doomed to failure. So our approach, the Better Investing approach, the approach used by our Investor Advisory Service newsletter in our Toolkit 6 software, is independent of market cycles because we understand the one true thing about the stock market is that it is always bullish if you have a long-term perspective. The market is always biased on the upside as long as your time frame gives the market time to work out all the short-term gyrations, to let the noise impact the markets in the short term and focus on those long-term returns that you can earn from equities. Of course, the next question then is there a recession on the horizon? And recessions are a normal part of the economic and business cycle in the US and throughout the world. Officially, a recession is defined as 2 consecutive quarters of declining gross domestic product. And of course, this definition is up for all sorts of review and discussion and debate. Should we be using GDP or something else as the American economy has shifted away from manufacturing into more services and technology? Maybe GDP is not the most effective way at measuring economic output. So goes one argument. But if you think about this, if we're going to define a recession as being 2 consecutive quarters of declining GDP, we never will know that we're in a recession until 6 months after at least that recession has started, because we get these GDP numbers on a quarterly basis. We get estimates from the government, and then we get a finalized figure a couple of weeks later. So there are other ways and other economic indicators that various economists will use. And at UCLA, there's a group that publishes the Anderson Forecast that looks at the economy, and they actually for the first time in their history, released data and an alert in the middle of the month in between the regular issues to announce that according to their analysis, a recession had already begun in the United States. The International Monetary Fund in late March, so just this week, announced that they believe that a global recession had begun. Again, recessions are not especially predictable. There are all sorts of moving parts of the economy and many changing facets of US and global business. They don't all move in sync. The recovery since the last recession, which ended in 2009, has been very, some would say it's been very spotty, others say it's very inconsistent. The truth is that for every month where there are certain indicators like housing starts and jobless claims that have improved, there have been other indicators such as manufacturing that have declined and vice versa. And we never get the economy that's firing on all cylinders. Maybe we never will. Maybe that's not something that we can expect, but it just lends complexity to the analysis of the economy. Again, it just brings us back that if you're trying to predict a recession, you're probably not going to be very successful at it. No one's really figured out how to do this with any level of consistency over time. If we look at recessions, here is just recession 101. What do we mean by a recession? If we start off in a typical expansion phase of the economy, we see product and service supplies grow. So the economy is growing, consumers are buying, consumers are spending. That's the expansion phase. Eventually, the supply of products and services outpaces the demand for those products and services, because if you're a manufacturer and you're making stuff that people are buying, you're just going to make a lot of stuff because you want to sell a lot of stuff. So you're manufacturing all to satisfy the increased demand and to satisfy future expected demand. But at some point, you're going to end up with a whole lot of additional products, and you're going to be finding that it's difficult to move them. And so when that happens, the economy peaks, and then move to the next phase where a manufacturer starts saying, well, we're seeing some slowdowns in purchasing, so we're going to slow down our manufacturing. We're going to cut back on production. We're going to lay off workers. We're going to stop buying raw materials. We're going to stop, we're going to close facilities. And so that has a steamroller effect, because when you start laying off people, they stop purchasing, which reduces demand, which then is reacted to by suppliers by cutting supply back even further. So this is the contraction or recession phase of the economy. So everyone is contracting their business, they're hunkering down, they're doing the minimum to get by, they're not spending unnecessarily, they're not making big equipment purchases, they're just trying to get through the cycle to the next phase of the economy. So eventually, however, everything contracts to the point where it can't contract any further, where there's enough demand to meet that's satisfied by the available supply, and at some point then things start to turn around, and at that trough point, then we go back into the next expansion phase of the economy. If you look back over time, even going back to the years of President Kennedy in the White House, there have been movements to eliminate the phrase recession. In the 1990s, during the peak of the expansion phase, there was talk of a soft landing where we wouldn't have a recession. And every time history has proven that recessions are part of the cycle of the economy. If we look at it on a graph, it might be a little easier to consider the starting trough. The economy expands, we reach a peak, then the economy goes into contraction phase, a recession, and then that cycle continues. The growth trend and the actual growth actually increases over time, but we do go forward and then we come back a little bit. And that I expect will continue into the indefinite future. Now, during a recession, not all sectors and industries and companies are going to be affected at the same degree. For instance, grocery stores are largely considered defensive because people still shop at grocery stores, even if they're laid off. Now, restaurants can be both affected by recessions, and some restaurants, like fast food restaurants, tend to hold their own during a recession. People may eat out less at more expensive places, at casual dining places, but might still say, well, at least we can go to McDonald's and get a quick dinner there, and it'll be, we can still spend a few bucks doing that. So certainly heavy equipment manufacturers are considered very cyclical, because if your business is threatened, you're not going to be making capital equipment purchases. So you're not buying bulldozers and dump trucks. You're going to make do with what you've got. Healthcare, utilities, and consumer defensive stocks are considered part of the defensive super sector. And those industries are some of the best places that you can go during an economic downturn. Utilities are government regulated. They pay a dividend. Their rates are controlled by government regulations. So their business goes no matter what's going on with the overall economy. Yes, demand for electricity may come down in many cases. The structure of many utilities today is such that many are not producing all of their electricity needs and have to purchase it from other suppliers. So if demand goes down, their margins increase. So but that's, there's a hidden benefit to some utilities. Others are just going to continue along and pay out their dividends to shareholders, see a nominal increase in prices. Healthcare, likewise, doesn't shut down during recession because people don't necessarily pay for their healthcare directly. It's being paid for by insurance, by Medicare, by the government. Yes, I know people are not going to be covered by insurance. Yes, elective surgery may tend to fall off somewhat during a recession, but those are largely considered defensive sectors. And then the consumer defensive includes grocery stores, drug stores, for instance. Discount dollar stores are included in that. Walmart is considered defensive, again, because people need the stuff that Walmart sells. They will shop at Walmart because of the perception of the store as a low-cost outlet as opposed to a more expensive department store. If you're, well, I'll just run into, I need socks, I'll just run into the Walmart or the other discount store and pick up a pair. So those are good stocks to hold during a recession. However, I'm not saying go out and buy them now, because this should be part of your overall portfolio diversification scheme to include a healthy portion and allocation of defensive stocks at all times in your portfolio to prepare for the coming recession, or the recession when it does come. The best time to be defensive, the best time to put on your football helmet is before the game, not after the game. So keep that in mind. Beef up your defensive approach. Utilities don't factor into our Better Investing Toolkit fixed stock methodology too frequently, but having said that, it might be a wise defensive move to include a little bit of some utility stocks in your portfolio, which will provide a buffer during a recession. Here's a history of recessions and expansions in the US since 1925. On this graph, the green bars represent recessions. The white areas represent the expansion mode of the economy, and the S&P 500 is plotted on the graph to give you a sense of how did the market respond to these various depressions and recessions. Over on the left side, of course, the biggest green bar is the Great Depression of 1929, lasted through 1934 or so, and so that recession was so severe and so took so long to resolve. Obviously, the markets also tanked quite a bit during that particular period. As you go through the graph, in the middle of the graph, the 1960s represented a very long economic expansion. The markets just marched upwards, the go-go years of the 1960s, when technology stocks and the race to get men on the moon were first and foremost in many people's minds. In 1974, 75, the energy crisis caused and rising very high interest rates caused a pretty long recession. And then we get into the 80s, an expansion of the economy, then the 90s, historically long expansion, only to be bested by the economic expansion of 2009 to 2020, that historically long expansion that probably has recently ended. As you look at this graph, it's important to acknowledge that on the left side, you see a lot of recessions and not very long expansion periods. On the right side of the graph, you see it dominated by an expanding economy with very few recessions separating the different expansions. Part of that has to do with I believe the increasing role of technology and the forecasting of supply and demand. If you are a manufacturer these days, you don't get stuck with large warehouses of raw materials and parts because of the move towards just-in-time inventory delivery. You've got sales figures coming back from customers on a daily or weekly basis via the internet and computer programs that can monitor what customer demand is like, that help you gauge your production levels. And so all of these elements kind of put together, coupled with, as I mentioned before, the move away from basic materials and industrial manufacturing in the U.S. towards more service and technology has helped to, I think, create the right framework for lasting expansions. We do have recessions. We're going to have recessions going forward, but it's, I think, from this perspective, it's likely to expect them to be much less frequent going forward. Now, recessions and bear markets don't always coincide. We've had, if you look at this graph, there are many times when we've had recessions and the market has really been flat or even moved upwards during those periods. That is likely to continue. But only twice in history have we had a 20% or greater plunge in the stock market where we've not had a recession. So it's pretty reasonable to assume that we're in a recession here in the first quarter, that started in the first quarter of 2020. And that's backed up by current estimates of Wall Street as to corporate profitability for the 2020 year. Corporate earnings during a recession will typically decline significantly. Again, many companies will go into loss territory. And it's not necessarily the worst thing in the world for those companies. Peter Lynch likes to point out that during a recession, as companies retrench, they reformulate, they streamline, they become more efficient. Coming out of the recession, they're in a much better shape to compete and to deliver greater profitability in the future. But the downside of a recession will certainly be that weaker or smaller companies can certainly be bought out or taken over. Some companies are not going to survive. There will be many high-quality companies, however, which are going to perform better and recover faster during the recession. And as individual stock pickers, those are the types of businesses that we can more easily identify actually during a recession and help us in our stock selection as we examine those businesses and think about them for inclusion in our portfolios going forward. Here's what what Wall Street is currently estimating for the earnings of the S&P 500 for the 2020 calendar year. And as of this week, the consensus, according to FactSet, is that earnings for the S&P 500 will be 1.2% lower than 2019. You can see the trend, though, heading into January, there was a subtle downtrend. So analysts have been trimming their estimates for a number of reasons heading into January, and then once the COVID-19 coronavirus hit, then things really start getting adjusted downward through 2020. Having said that, not all sectors are likely to be impacted the same way. Here is the same data by sector for the S&P 500, looking at the estimated 2020 earnings per share growth. On the left side, information technology stocks expected to deliver earnings up 7% on average, healthcare up 5.8%, communication services up 4.7%, real estate up 4.4%, which surprised me, utilities up 3.3%, consumer staples up 3.1%. And then on the far right, you can see energy dragging down the entire sector, with earnings expected to be 62% below 2019 levels. Again, the energy sector is having its own perfect storm of not only a recession and the stay-at-home mandates that have been enacted across the country, which are keeping people from driving to work or going out very often in their cars. Interstate travel in many places is being discouraged. So energy companies seeing lower demand and in the face of it, lower prices because of the Russia-OPEC disputes. So fuel prices as low as I've seen in the last couple of weeks, $1.45 a gallon in Michigan, and those could get even lower as we go forward, depending on where you are around the country, but really holding back financials, basic materials, consumer discretionary, and industrials, all pegged at seeing earnings levels well below 2019. So keep that in mind. When you add that all together, yeah, recession looks pretty likely. Corporate profits look to be pretty much lower for 2020 2020 as a whole. During recession, this is when the federal government tends to step in, and we've had the $2 trillion stimulus plan that was passed by Congress last week. Did have a positive short-term effect on the markets. The Fed typically will respond to recessions with bailouts, quantitative easing, reduced interest rates, although now interest rates are about as low as they're going to go before they go negative, and increased federal spending. So we expect more of that as 2020 moves on. And having said that, yes, there are big concerns about how we're going to pay for this $2 trillion stimulus plan, with corporate taxes having been reduced so significantly in 2017. And then now we're going to see corporate profits going down in 2020, which is going to reduce the income taxes that corporations pay this year. So inflation is definitely a big concern, as well as coping with a humongous national deficit. But that right now is nobody's first and foremost concern, but really what can we do to help individuals and small businesses and large businesses alike. And so that's certainly what we can expect this year. And how the market responds to the stimulus package has been mixed. It's certainly a sign, a step in the right direction, but there are significant concerns that it may just not be enough, especially as mandated shutdowns of businesses continue, and the length of time from here, March 31st, now we're looking at least April before some of those restrictions get lifted. That's going to be another month of very difficult time for many, many businesses. If we try to be realistic about the expectation with an optimistic outlook, perhaps by the third quarter of 2020, we might have moved out of this recessionary phase. The UCLA and Anderson forecast predicted that normal economic activity and growth of 4% would be resumed by the fourth quarter of 2020. That would be terrific. So one way to look at that right now is to essentially assume that the first three quarters are going to be pretty dismal for most companies. In looking at the smaller companies that I follow for our Small Cap Informer newsletter, I've been predicting flat to 20% declines in earnings and or revenues for 2020 compared to 2019, and then focused on recovery from 2021 through 2024, 4 years at a reduced growth rate, and to see what the potential total return might be. And so we'll talk more about that particular approach perhaps in a future webinar. So let's talk about what you can do right now as an individual investor focused on this market. Here are some of the key things that I think you should keep in mind and put to work in your own individual action plan. Well, let's go to Mr. Buffett, who famously has said that it's best to be fearful when others are greedy and be greedy when others are fearful. I think right now we can generally categorize the approach of investors in this market as being fearful, and that should be our cue as long-term focused investors to be greedy, to be looking for opportunities, to not be spooked out of the market just because of all of the elements and the unknown that is there, to keep our confidence in the long-term approach. So first of all, remember that bear markets always end. Historically, every bear market in the United States has ended, and usually in a period measured in months, not years. So I think we're not looking at 2 to 3 years of recovery of the markets. We're looking at something like a period of 6 to 18 months would fit with the historical model of how bear markets have ended in the recent past. Number two, remember that recessions end. And again, we have a 100% track record in the US of seeing every recession in history ended. Again, in periods measured in months, not years. So we're going to see a pullback in the economy. We're going to see businesses struggling for a short period, hopefully, before they are able to resume their upward trajectory. Number three, don't dump your stocks. There's no need to sell your stocks outright. If you were going to sell your stocks, you should have done it in the middle of February when the market was at its high. Oh, you didn't know? That's because we only learn about those highs and lows in hindsight. The market might go up from here. We don't know. If you sold now with the S&P 500 down 20%, you could be missing out on a significant amount of gains going forward. If you decided, well, I'm going to move out of stocks and into some other asset class, well, there's nothing else out there that's going to be any more certain than stocks. So switching is not going to work up. Are you going to move into the bond market? They've got their own problems right now. You're going to go to corporate bonds. Again, that's a possibility, but there's going to be a lot of corporate bond defaults we would expect going forward. For the higher yielding ones, higher yielding corporate issues, are you going to move into precious metals and own gold? That's not very liquid in many cases. To own gold directly. Are you going to go international? We've got a global recession. Markets are crazy around the world. Are you going to hit emerging markets? Boy, that just seems like something very risky. So U.S. stocks seem to be as safe a haven as ever. And then finally, are you going to sit on cash? If you moved out of your portfolio into cash at this point, what's the sign that you should move back in after the market's gone up 20%? Well, then we would be well out of the bear market, but you've just missed an enormous 20% gain in the market. So not selling right now is a very wise and prudent decision if we look at history and let it be our guide. Having said that, there's nothing wrong with selectively replacing some of the stocks that you're holding. If the companies are viable, if they do have sound balance sheets, high quality metrics, and potential for growth after the current crisis has ended. Even if you're holding them at a loss, it could be the best thing you could do would be hold on to those companies. But having said that, selectively look at some of your stocks. If you've got some with capital losses, if you have any gains, it makes sense to sell and capture the capital losses. If you want to reduce your income and trigger a capital loss, you could do that as well. And then my approach is to replace, not sell stocks. So if you've got a better alternative than a stock that you're holding at a loss, it can make all the difference in your portfolio and in your mental well-being to sell that loser stock and put the money into another company that you're convinced is a better performer. Focus on 2024, 2025. So the end of 2024 would be 5 fiscal years from now. If you think about where the market is likely to be in 10 years from now, this bear market is going to be a distant memory, just like the memories of the 2008, 2009 bear market, memories of the 2000 bear market are distant memories that are just a tiny little blip in our collective investors' memory. Keeping that long-term perspective can be very healthy for us, and that's why we invest. We don't invest to protect ourselves from the unavoidable gyrations in the market around different bear markets. It's impossible to predict what's going to happen in the near term, but we can look at the long term and be 100% confident. Yes, I know there are some people who are not 100% confident in the future of the American stock market. As I always like to say, you could build a bunker, stock it with gold and ammunition and canned goods, sell all your assets, live off the grid. The fact that most people don't do that is a sign that there's room for the capitalist method to continue to work, and there's a lot of people who are invested in that concept as well as invested in the market. So let's focus on 2024, 2025, and just let the water roll off your back, like the water off a duck's back, everything, all the bad news that might be yet to come in the current market. For your regular investing plans, if you've got, you're a member of an investment club or you're contributing to your 401k, as much as possible, maintain and or increase those contributions. If you're taking advantage of an index strategy, as I do in my 401k, one of the things that I do when we get a big market decline like this is at least temporarily bump up my paycheck to allow me to contribute more and buy more shares when values are low. If you do that when the market recovers, the investments that you're making now are going to show some pretty significant gains. Wealth is made in bear markets over the long term. For investment clubs, the ones that meet regularly during the bear markets, and today they're meeting virtually using online meeting tools, but they're continuing to make their monthly contributions. They're continuing to manage their portfolios and provide support to each other. And those clubs are going to perform better over time than the ones who in the bottom of the bear market decide it's too depressing and decide that they're going to disband at the bottom. It's absolutely the wrong way to invest. So maintain those plans and keep moving forward. Next, buy quality companies whenever you find them. At this point, there are bargains galore in the market, so a careful buyer of select companies. With the prices declining of so many stocks, you'll see all sorts of stocks selling at low valuations and high potential returns that have not been seen in many years. Yes, I know the picture for the rest of 2020 may be somewhat murky, but good companies are going to come out at the other end of these current crises and perform exceptionally well. So use this rare opportunity to buy big stocks, buy stocks at big discounts. You don't get very many opportunities like this, so let's not squander them, but be practical and pragmatic about our approach. So I touched on this earlier. I'm a big believer in the challenge approach. I'm a believer that you should be maintaining a watch list at all times of stocks that you like that are just kind of expensive. And now you've got the opportunity to buy these companies at reduced prices by using that challenge approach. Take a stock that you've got in your portfolio, take your best ideas that you're able to find by using screening, by reading Better Investing Magazine from our investor advisory service or small cap informer newsletter, take those new ideas, plot them and compare the total return, and then redirect your assets toward the absolute best stocks you can find in the marketplace. And this, again, will strengthen your overall portfolio. It will increase the quality, and it will increase the total return from this point going forward. There are lots of investment analysts who are already coming out and talking about the bargains that are available in the stock market now. The investment research firm Jefferies published a report on March 16th. It was called Practically Stealing. It detailed their 47 best ideas in the stock market, what they called, quote, high quality names that investors would want to own across a cycle, great companies that have strong business models, healthy cash flow, and very robust balance sheets. These are the types of companies that look good on the stock selection guide, that are of high quality and have great total return potential. In this week, BlackRock CEO Larry Fink wrote a letter to customers that talked about the, quote, tremendous opportunities to be had when the economy recovers from the coronavirus pandemic. He said, quote, as dramatic as this has been, I do believe that the economy will recover steadily, in part because this situation lacks some of the obstacles to recovery of a typical financial crisis. And that's a very interesting perspective. He's pointing out that besides the pandemic and the health crisis, the financial markets are not entangled like they were back in 2007, 2008, 2009. And that's going to help really direct the recovery. A lot of companies had been borrowing money at very low interest rates, but balance sheets remain pretty strong for many companies. And so we would expect those companies to recover. So we've got analysts already out there talking about using this opportunity to find opportunities for your personal portfolio. Now, I wanted to cover with just a few warnings before I touch base on some investment ideas that you might consider from our newsletters. First of all, watch out for high-yielding stocks. Many stocks, as the price has fallen, the yields have shot, the indicated yields have shot through the roof. But many companies are already putting the brakes on dividends, either reducing them, pausing them, or outright eliminating them for the time being. And so high yields are definitely at risk. Now, when you can find a company that's got a good balance sheet, that has a good yield, that might be a good opportunity, but watch out for it. Watch out for what the market calls dead cat bounces. When the market goes down, it tends to have a couple of fake out recoveries where it goes up a couple of percentage points and then it declines again and finds new lows. And these are bull traps, they're also known as, where investors think, oh, okay, the market's turning around now, it's going up. What actually happens is it's a fake out and the market goes down. It's just impossible to predict with any certainty the direction of the market in the short term. Remember that the current market is not reacting to fundamentals. The stocks in this market are being driven by fear, anxiety, sentiment, and lack of data. The next round of quarterly earnings reports, which I expect as we get into the April-May period, are going to give us more clarity, more hard facts. Some companies have already come out and suspended their guidance for fiscal 2020. Understandably, they're saying, yeah, we made a lot of assumptions based on a lot of factors. Now those factors are all under review, and so we're withdrawing what we said before. We're not sure where we're going to end up this year based on everything that's going on. So putting your portfolio into a holding pattern at this stage is not necessarily a dumb thing to do, pending further information that will help you make decisions. The risk is that companies are going to come out and tell you exactly how bad it's been and the market's going to react unfavorably. My feeling is that for most big companies, large companies, the fear has already been priced into it. The expectations are very low for many companies in their next earnings release, and so that is probably not a very big risk at this point. But the market can always go lower, and we got to keep that in mind as well. So let me talk about a couple of investing ideas. These are stock ideas for you. They're stocks for you to consider, and I'll talk about the rationale that come from our 2 investing newsletters. The Investor Advisory Service in the April issue, which was published on the last week of March, recommended CarMax, which is an interesting selection because this is a used car dealer. They operate 200 used car superstores around the country. But typically on the upper end of the used market, so cars that are less than 6 years old with only one prior owner. So this is one of the largest of the most successful of the used car chains around the country. There have only been a couple of others, and none have really been as successful as CarMax. One of the advantages of a company like CarMax from our analyst perspective is that they have a very strong balance sheet, and you need to separate out their consumer auto finance section, which is making loans to car owners, to purchasers, and then they're placing those loans with investors. So they're the middleman. So they're making money on both ends, and so that inflates the debt on their balance sheet. If you strip that out, they're in good financial condition, and that's going to help them make their way through the current recession and come out beyond it on the other side. So interesting company to consider. Lamar Advertising also is a real estate investment trust, but this company focuses on outdoor advertising, so billboards, including digital billboards, and logo displays that notify motorists of restaurants and gas stations at freeway exits. So they've been in this REIT status since 2004, so they pay out their income as dividends. So during a recession, we would expect advertising to go down a little bit. However, during the company's worst year, their cash flow supported 75% of the current dividends. So we would expect that during a recession, they would be able to maintain their dividend even if they didn't have the income to cover it temporarily until the recovery came back around. So very interesting selection there. A little bit more of a yield at the recent price that you might get from that particular company. And then Nike, global leader, right? Few brands have that reputation as Nike does. So here's the opportunity to buy it at a PE ratio that is as low as it's going to go as the price reaches its 52-week low. It's a high quality company. It does have a little bit of a yield. Yes, it's going to get impacted by the recession, but they have got such a great brand name that it could deliver some good returns going forward. On the small cap side, we focused on two companies related to healthcare. AMN Healthcare Services is a staffing business primarily for the healthcare business. So doctors, nurses, technicians, temporary staffing, executive search, recruitment, outsourcing. That's all critical right now as the healthcare industry needs all the help it can get. So AMN has been able to provide and match up employers with employees who are trained, who are doing the job. They made a recent acquisition that gives them a telehealth vendor, a video remote language translation service again. So that makes a whole lot of sense in the current market as well. And Icon PLC is an Irish company. It's global, that operates globally, that manages contract research outsourcing. So they manage the clinical trials and testing for other pharmaceutical businesses. So they've got a big program in place right now to help accelerate COVID-19 antivirus and treatment testing. And they have remote testing already in place where they can do testing away from facilities and help pharmaceuticals and biotech companies. So I think that's a really interesting business that has some relevance to the current situation for investors who are looking at that aspect of the current crisis and what they might invest in as we go. And so with that, we're going to wrap it up for tonight. I want to thank you for joining us. My mantra through the recent crisis has been stay the course. Every opportunity I've had to interact with investors, subscribers, investment club members has been to carry forward that message that right now the best thing to do is keep calm and stay the course. Stay the course with your personal portfolio. Don't be making lots of significant changes. Stick with your asset allocation and your portfolio diversification plan. Don't mix it up right now. It's not the time to do it. If you decide that it really didn't work out for you when the recovery happens, then you can make adjustments so that you're better prepared for the next time. If you find that it might have been a good idea to be more defensive in some of your portfolio selections in your portfolio, you might be able to find some defensive stocks right now that you could add to your portfolio. But again, you're going to have an opportunity as the recovery commences to make those adjustments. So for now, the best thing you can do might be to do nothing at all, to sit tight, to sit at home, not pay a whole lot of attention to the business headlines, to the financial news networks right now. Turn off the television, read a book, spend time with family. Get out, go for a hike, a bike ride, a run, but whatever you do, stay the course, and we're going to get through this together. So thanks again for joining me. I look forward to hearing your responses to this webinar and to meeting with you again in the future to deliver some additional guidance and insight as the situation evolves. But once again, I'm Doug Gerlach from iClub Central. Thanks for joining me.